the biggest mistake traders make. What if the single biggest mistake most traders make isn't losing money, but chasing the completely wrong dream? Day after day, thousands of people fire up their charts full of hope, convinced they're just one perfect strategy, one magic indicator, or one viral YouTube setup away from effortless financial freedom. For a short while it works, they catch a nice move, the dopamine floods in, they screenshot the green numbers and fire them off to friends or post them online. Then reality arrives, setup stops working. Losses stack quickly, the account starts shrinking fast. That cycle isn't random failure, it's the seductive illusion of success. To a no-nonsense look at what actually matters in trading, psychology fused with cold mathematics. Quick note, nothing here is financial advice. It's purely educational material about how probability, discipline, and risk really behave in markets. Your capital, your choices, your responsibility. Picture two doors. One leads to boring consistency, small, steady gains that compound quietly over months and years into serious wealth. Door two promises fireworks, account doubles in a week, adrenaline, bragging rights, then frequently, total wipeout the following week. Almost everyone claims they want door one, yet their behavior screams door two. They chase hot signals, leverage, skip stops, hunt home run trades. Markets punish that choice without mercy. Gurus selling 2,000 courses rarely emphasize the unglamorous truth. Trading success has almost nothing to do with predicting tomorrow's price. It isn't about nailing tops and bottoms or outsmarting everyone else. Real edge comes from constructing your own repeatable method where probability works slightly in your favor, losses stay tiny and tightly controlled, and occasional wins are deliberately larger by design. That isn't gambling or guesswork. It is applied mathematics wrapped in iron discipline and grounded psychology. Price action, expectancy, to reward, these aren't sexy topics. They won't turn 1,000 into 1 million next month. But they explain exactly how legends built lasting fortunes. Dennis grew 200 into roughly 400 million through disciplined trend following. Rakesh Jhunjhunwala became a billionaire in India with win rates often below 40–45%. Neither relied on being right most of the time. They relied on systems that delivered positive expectancy over thousands of decisions. This discussion isn't aimed at shortcut chasers. For anyone ready to understand the real architecture behind long-term trading success, we will cover the most common illusions that trap people. Coin toss experiment that exposes expectancy, the brutal 95% failure statistic, price action's hidden paradox, survival mathematics, rule-based execution, turning randomness into edge, the mindset revolution, and endless refinement. By the end, you face a clear fork: stay dreaming or start trading like a professional. Two roads in the 95-cent trap. Every new trader stands at the same fork. One path offers modest stability, carefully risked trades, gradual equity growth resembling a healthy plant receiving daily water. The opposite path dazzles with overnight riches, huge percentage gains, viral screenshots, thrill of being right against the crowd. Nearly everyone verbally chooses stability. Yet actions tell the real story: signal chasing, revenge trading, no stops, oversized bets, chasing fireworks. Trading forums and social media amplify the distortion. Winners get posted like trophies, 300% in one day. What never appears are the silent graves, accounts blown. Profiles abandoned after drawdowns erase months of work. Only champagne moments go public. The brutal hangovers stay private. Therefore, conclude that slow compounding is boring and inadequate. Here is the statistic that should jolt anyone: roughly 95% of retail traders lose money over time. Good disclosures frequently report 78% of retail CFD accounts lose money. These aren't marketing disclaimers, they reflect reality. Most fail not from stupidity or laziness, from falling into the same predictable trap, worshipping individual methods instead of building robust systems. They hunt the holy grail indicator, the guru's secret pattern, course promising 90% accuracy. When it inevitably breaks, they strategy hop endlessly instead of asking the only question that counts. Does this approach have verifiable positive expectancy? A painfully common story: newcomer finds Forex crypto stocks, searches best strategy 2025, buys into hype videos, copies signals or templates, feels invincible. Then comes the first string of losses. Emotions spike. Instead of examining the math, they blame the setup and jump to the next shiny thing. Capital erodes, hope fades. Professionals, the surviving 5%, behave differently. They ignore win rate obsession. They obsess over expectancy. They backtest rigorously. Losses as business expenses, not personal insults. Legendary trend follower Ed Seekota summarized it perfectly: win or lose. Everybody gets what they want out of the market. Most secretly crave excitement, drama, validation, not boring consistency. Markets mirror desires. Term thrills followed by long-term ruin. Contrast that with Richard Dennis's famous turtle traders experiment. He recruited complete novices, actors, card players, office workers, and taught them straightforward trend following rules emphasizing discipline and position sizing. No secret sauce. Results weren't explosive month to month, many periods were flat or negative. Several years, however, the math compounded into enormous gains. Expectancy, strict risk control, longevity. Pause for 10 seconds right now. Forget what you say you want. Honestly, at your last 20, 30 trades. Which road do your actual habits reveal? The discomfort you feel answering that question is usually the first genuine step toward real change. Prediction illusion and price actions paradox. Nothing hooks traders harder than the fantasy of prediction. Charts open, brain immediately asks, up or down next? Buy here. Certainty feels safe, uncertainty feels like chaos. Millions therefore hunt crystal balls, indicators, newsletters, AI predictors, anything promising tomorrow's direction with high confidence. History slaps that fantasy hard. In 1998, long-term capital management, staffed by Nobel economists and PhDs running supercomputer models, collapsed spectacularly, losing $4-6 billion and almost destabilizing global finance. They thought prediction was solvable. In 2020, WI crude futures briefly traded negative. Virtually every sophisticated forecast model missed it completely. Action frequently gets sold as the antidote to prediction addiction. Red pure candles, no lagging indicators, know exactly what happens next. Traders adopt the label proudly. I'm a price action trader, as though it confers instant wisdom. Yet most use price action to fuel exactly the same illusions they claim to reject. They spot a pin bar and announce reversal. They identify head and shoulders and predict collapse. One win, profit status. One failure, gay shrug, hunt next pattern. Truth, price action isn't prophecy, simply the unfiltered record of buyer-seller battles. Each bar, wick, and close shows momentary supply, demand imbalance, nothing more. Engulfing candle means buyers overpowered sellers that period. It does not guarantee the next candle explodes higher. Real value emerges only in context, trend direction, key levels, volume behavior higher, time frame alignment. Remove context and most classic patterns perform near random. Researchers once generated purely random price series using coin flips and showed them to experienced traders. Professionals still saw head and shoulders, flags, support, resistance. Brains love patterns, even fake ones. Quantitative tests across decades of data confirm standalone classic patterns win roughly 50-53% of the time, basically a coin flip with prettier pictures. Add proper context and edges of 55-62% sometimes appear. Small but repeatable enough to compound when paired with strong risk-reward. Paralysis is the silent killer that follows. Traders draw lines on every time frame until charts resemble spider webs. More lines to more certainty. Reality. Conflicting signals increase hesitation. Overanalysis breeds paralysis. Rakesh Jhunjhunwala became a billionaire despite win rates frequently below 40%. He was wrong more often than right. Correct, however, winners were 5 fee, sometimes 120 larger than losers. He didn't predict tops bottoms. He positioned asymmetrically with strict risk definition. Reflect on your last loser. Honest question, did you lose because prediction failed or because you lacked a clear plan for being wrong? 5. The coin toss secret of expectancy. Forget indicators and patterns for a minute. Let's run a game that permanently shifts how you view trading. I flip a fair coin. Heads you win 150. Tails you lose 1. Play once with your last dollar. Probably not too scary. Now imagine 100 bankroll and 100 flips. Math changes everything. Expected heads E50 of 51s feet and 75. 50 to 50s limb and 50 in net expectancy now 75 plus 25 after 100 flips. Nothing fancy. Just structured asymmetry. You win more on correct flips than you lose on incorrect ones. Over many repetitions the edge compounds. This is professional trading's core secret. Success isn't high accuracy. Engineering games where losses stay small and wins get paid disproportionately larger. The expectancy formula is brutally simple yet powerful. Expectancy. Dennis's turtles occasionally ran win rates as low as 30-35%. Some stretches showed only 5-10-cent winners, yet they made fortunes because rare trend, captured trades paid in 20 times. 5. The small losses. Math overwhelmed randomness. Break-even thresholds clarify the leverage asymmetry provides. 1-1 risk reward need 50-cent wins to break even. 1-1. 5 need only 40-cent wins. 1-2 can need only 33. 3-cent wins. 1-3 need only 20% wins. You can literally be wrong 2 out of every 3 trades and still profit consistently. Average 3 times the size of losers. Van Tharp spent decades teaching exactly this accuracy obsession without reward. Asymmetry is financial suicide. Casinos illustrate perfectly. Edge on roulette lead to 7-cent tiny, yet millions of spins later billions in profit. Traders should aim to become the casino, not the desperate gambler. Your edge expectancy. Streaks mean nothing, large sample sizes reveal truth. Quick example, risk 100 per trade, target 200, realistic 40-cent win rate. Expectancy per trade at 80, 60 till 20. Footler 2 though hours unexpected. Not from wizard predictions. From game design. Quafu survival mathematics, risk and anchors. Can possess the world's best expectancy curve and still go bust. How? By mismanaging risk per trade. Per trade maximum percentage of total capital you allow any single position to lose. Professionals almost universally cap at 0.5%. Amateurs laugh. How do I get rich risking so little? That attitude explains exactly why amateurs vanish while pros survive decades. Math of ruin is unforgiving. 10% per trade at 10 consecutive losses to account T0. Even a 60-cent win rate system produces 10 loss streaks occasionally. Risk 1 cent per trade, a 10-loss streak, a 10-cent drawdown. 10% requires 11, 1 cent gain. Recovering 50-cent requires the 100-cent. Recovering 90-cent requires the 900-cent. Small risk preserves capital through inevitable strings of losers. Risk turns survivable drawdowns into extinction events. Rakesh Junjunwala again accuracy 40%, yet billionaire status because losers never threatened survival. Position size stayed disciplined. Psychologically defined risk is liberating. Knowing maximum damage to 1 cent removes panic. You stop staring at every tick. Stop moving stops in hope. Clarity returns. Anchors protect you from yourself. 1. Hard stop, loss F. Non-negotiable exit when price hits predetermined invalidation. Not a suggestion. A shield. Moving stops wider when price approaches turns small, acceptable losses into disasters. 2. As defined take profits. Locks in reward side of ratio. Prevents winners from reversing into break-even or losers. Enforces asymmetry mechanically. George Soros captured it. It's not whether you're right or wrong that's important. How much money you make when you're right and how much you lose when you're wrong. Seatbelt analogy useless 99% of the time. Life-saving during the crash. Traders skipping stops eventually crash fatally. Those ignoring take profits watch edges evaporate. Personal turning point. Once I preset stop and target before every entry. Session with live price action vanished. Execution became calm. Freedom followed. Challenge calculate 1% of current capital. That becomes max risk per trade for next 30 days, no exceptions. Psychology shift dramatically. Funplay from chaos to system, rules and testing. Losing traders share one trait chaos. Impulse entries, fear exits, gut feeling, justifications. Reward structure, not feelings. Rules transform gambling into probability management. Paul Tudor Jones, don't focus on making money. Focus on protecting what you have. 2 traders. Same USD bullish engulfing. Trader A enters on impulse, no stop, no target. Market reverses, key averages down 300 pips. Trader B, requiring engulfing at daily support after pullback in uptrend. Stop 2 pips below low, target 20 risk. Stopped out 20 pips, moved on. Same setup, different outcome. Rules decided survival. Don't restrict freedom, they create it. Clear criteria remove doubt, hesitation, second guessing. You execute or you don't, no endless debate. Rules must be proven. Enter backtesting. Backtest apply exact rules mechanically to hundreds of thousands of historical setups. No fudging. This time felt different. No hindsight bias. Pure statistics win cent, loss, max drawdown profit factor, expectancy across trending ranging choppy regimes. Prop firms and serious funds refuse to risk real capital on untested ideas. Traders frequently skip testing, go lev, blow up, blame, the strategy, repeat cycle. Backtesting reveals personality. Some systems crush trends but bleed in ranges, thrive in chop but die in momentum. Knowing that allows intelligent position sizing instead of blind abandonment. Once statistics confirm positive expectancy, doubt fades. Says it happens 15% of time with typical edges. No panic. Process continues. Reality check. If you haven't backtested any strategy over 100 trades with fixed rules, you aren't trading, you're gambling. Commit today, test next idea historically before risking capital. Turning randomness into edge. Markets appear chaotic, random spikes, fake-outs, news shocks. Beginners feel like predicting leaves in a storm. Professionals understand, eliminate randomness. You tilt odds slightly. Coin toss game again 50-50 becomes profitable by attaching asymmetric payouts. Trading works identically. Stack filters until probability leans your way. Filter 1D Lee 53-55%, filter 3 to 57-62 small edge. Repeated hundreds, thousands of times plus strict risk control, compounding wealth. Turtles won with the 30-35% hit rates. They didn't fight randomness, they harnessed it. Big trends paid massively. Small losses, fatal error, abandon rule after 8-12 losers. Probability needs large samples. 10 tails flips don't erase heads. Your last 20 trades reveal almost nothing. 500-1000 trades reveal edge. Mission isn't avoiding losses. Mission is designing framework where losses are frequent, small, and dwarfed by rarer but much larger wins. Mental model. Some customers beat you. Fine. Large volume clubs, tiny edge house wins long term. Avoid losers. To expect losers as cost of doing business. Losses become design feature, not identity threat. 5. The mindset revolution. Truly charts and indicators fade. One truth remains: trading is 80-90 cent psychology. Greatest opponent isn't price action, it's you. Early stage identity tied to being right. Inflate ego, losses feel personal. Screenshot winners, hide losers. Poisonous. Professional shift question: was I right? Or God, did I follow my rules? Single trade outcome irrelevant. Data point in infinite series. Only controllable variable rule adherence. Mark Douglas: best traders think exclusively in probabilities. Emotion detaches from individual results. Identity anchors inconsistency, not accuracy. Loss redefinition, not failure, business expense. Restaurant buys ingredients that sometimes spoil. Trader pays small losses for chance at big wins. Acceptance removes fear's grip. Personal breakthrough, 5 consecutive losses. Normally devastation, revenge trading. This time, system stats showed 40% win rate, Len 2 ratio 5 loss streak probability, Lie cent math not curse. Took 6 trade calmly. 1, then 2 more. Equity recovered. Mindset prevents sabotage and no tilt after losses. No recklessness after wins. Steady execution. Challenge next 10 trades. Score only one thing. Rule following. Ignore P&L. Thunder 10 profits follow naturally. 5 have endless refinement and final truth. No system is ever finished. Markets evolve, volatility regimes shift, correlations change, participants enter. Static methods die. Great traders refine continuously. Hypothesis. Gay rules. Backtest a adjust retest. Small tweaks, never wholesale abandonment. Jesse Livermore Madig lost several fortunes. Each bust provided data, he adapted. Trend following foundations he helped shape persist today. Amateurs restart cycle endlessly after short tests. Recognize drawdowns as normal testing. They adjust sizing or filters, not core logic. Every method has seasons. Trend systems suffer ranges, mean reversion bleeds in momentum. No personality size positions intelligently during weak regimes. Refinement requires humility. Believing perfect invites humbling losses. Cycle never ends, and that's beneficial. Edge. Assignment: analyze last 20-30 trades by condition. Compute win cent per regime. System likely prefers certain environments. Exploit that knowledge. Strip hype away. Action markets raw heartbeat. Buyers vs sellers captured in candles. No magic, no certainty. Only data weighting structure via rules, expectancy, risk control. Succeeded through probability are disciplines, asymmetry, not illusions. Market tests, daily seduction via easy wins, punishment via surprises, whispers that this time is different, special. None of us are. We're probability managers tilting odds. Price action always works because it is simply language. Question is whether you translate language into method. Rigorous testing, defined risk, unwavering process through drawdowns. Edge weights, truth weights. But only for those trading prediction fantasy for probability discipline. Your action plan to join the 5 cent. Knowledge alone saves nothing. Action does. 1. Test expectancy brutally. Practice current method. 100 trades with fixed rules. Calculate win cent. Average loss. Expectancy positive. Continue negative. Stop immediately. 2. Lock risk. Max 1-2 cent per trade forever. Right rule. Violate once a reset month. Survival victory. Phase 1. Mindset pivot. After every trade ask only, did I follow rules? Ignore outcome. Consistency compounds. 4. Eyes journal religiously. Log entry reason. Stop target. Size ascent. Motion notes. Review weekly. Patterns emerge. 5. Build community. Comment your current win cent risk reward. Accountability accelerates growth. 6. Next 10 trades. Track only rule following. Aim $10. Profit becomes side effect. Share this with one struggling trader, not for clout, but to shorten their pain. Subscribe if you want more depth on psychology, expectancy building, risk frameworks, no hype, just mechanics that separate 5% from 95%. Don't consume, act. Open journal today. Document next trade honestly. After 10, compute expectancy. That number predicts your future more accurately than any indicator. Markets respect only discipline, probability, risk management will come. Question is whether you enter blind or armed with process. Choice yours. Transformation starts with very next trade. Make it count.